What do you look for, generally speaking, in a short?
I have a list of do's and don'ts.
Today, we're going to do something a little different. So your firm specializes in shorts.
We look for problem with the business model, product issues, scalability, and the management. It's always the management.
Bad management.
Very bad management. We were recommending an airline as a short. We heard from one of our sources saying that this management is so fraudulent. They don't do any maintenance on their airlines. The CEO gathered the team and said, I don't care if the engine falls out of the plane. You do not ground the plane for any reason. It costs me money.
I think that's bad.
That's very bad.
So what was your thesis? Why was this company in trouble?
That's when we realized, Steve, this car industry is such an organized mess. They are all in it together.
I'm shocked. Do you think Stellantis goes lower?
Eventually, it will be lower single digits, yes.
That's a good short.
Thank you.
Two solar shorts.
So SolarEdge and Enphase advertises that their failure rate is less than 1%.
Okay.
But their failure rate is roughly around 40%.
Oh my God. The first lesson is don't short a cult.
Well, we learned the lesson the hard way.
This is one that I have said publicly many times. Never short a stock purely because of Hi, this is Steve Eisman, and this is another episode of the Real Eisman Playbook. And today, we're going to do something a little different. Let me first introduce my guests, Lakshmi Ganapathi
Hi, Steve.
of Unicus Research. So as you all know, I really like boutique research because I find it to be superior generally to bulge bracket research, with some exceptions. And there are a few, and I really mean a few, boutique firms that specialize, dare I say it, in shorts. So there are actually two, and we're going to interview both of them. And today we're going to interview the first one. Lakshmi, welcome to the Real Eisman Playbook.
Thank you, Steve. Thanks for having me.
So your firm specializes in shorts, and you write research. You print it, so you're open to lots of criticism given what you write. So let's take a step back. What do you look for, generally speaking, in a short?
Well, when we look for shorts, we look for structural catalyst for a specific company. So we look for problem with the business model. We look for product issues. We look for issues with scalability. And we look for issues with the management, among other things.
So when you say issues with the management, what do you mean by issues with the management?
Well, a while ago, not right now, a few years ago, we were recommending an ultra low-cost carrier as a short.
I'm sorry, what?
An ultra low-cost carrier, like an airline. And it goes from a small city to another small city.
And what was the name of the company? You don't want to say.
I don't want to say because I will tell you why. I reached out and filed for Freedom of Information Act to get a list of problems with that airlines. So we spoke with ex-pilots.
This is a short carrier, meaning planes.
Yes.
So someone like a mini FedEx.
Yes.
Okay.
Yes. It's like it doesn't do international travel. It's a budget airline.
A budget airline for commercial transport.
No, for passenger.
For passenger. Oh, so this is a passenger company.
Yes.
This is not a FedEx. This is like a Spirit Airlines or something like that. Okay.
Yes.
You won't say if it's Spirit or not, but something like that.
It's not Spirit.
But something like that.
Yes.
Okay.
So we filed the Freedom of Information Act, and we were told by a mechanic who became a whistleblower saying that this management is so fraudulent. They don't do any maintenance on their airlines. And I started digging. So we heard from one of our sources that the CEO gathered the team and said, I don't care if the engine falls out of the plane. You do not ground the plane for any reason. It costs me money.
I think that's bad, but okay.
That's very bad.
That's very bad.
That's very bad.
Okay. So let's go over it again. The things that you look for. You look for something bad about management.
Yes.
You look for structural problems with the business.
Yes.
You look for not necessarily structural problems with the business, but maybe there's a problem with the product.
Yes.
And what else?
We also look for scalability. So, for instance, companies, EV companies,
Electronic vehicle companies.
we recommended a lot of them as a short, and some of them are out of business. For instance, companies like Fisker, companies like
Fisker. I've seen some of their cars on the street.
The problem with all these EV companies, electric vehicle companies, is that they have problems scaling their product to
Why?
cost.
Meaning, elaborate on that.
So we hired a battery systems engineer from QuantumScape before we started researching this, and 40% of the EV batteries cost is attached to the sticker price, meaning unless you reduce the price of the lithium battery that goes in the car, it's very expensive to
manufacture
at the scale that you want it to.
Elaborate on that for a second. I'm not quite sure I understand.
So the manufacturing process of an electric vehicle starts with the battery, starts with assembly, and it involves an enormous amount of cost. I can't give you the exact detail of how much it costs, but when an electric vehicle company like a Fisker comes to business via SPAC, goes public, and they claim that they will do X, Y, and Z, for instance, swapping the batteries instead of charging the car. And they have a lot of concepts that they want to be implemented in the car, but it's not feasible, probably due to engineering, probably due to cost. It's not feasible to do it. So when those companies become public, the valuations of those companies were based on what they can do 5-10 years from now.
Right.
But the problem comes when the reality catches up with the perception of where the company is going to go. And that's what we look for.
Okay. All right. So let's start with, I've read a bunch of reports of yours, and let's start with a company that I think is a classic short, which is Stellantis. So you recommended shorting it in June of 2024. The stock was 20.
Yes.
And as of, I think, yesterday, it was $9.40. So that's a good short. You got cut by more than half.
Yeah.
So why don't you first describe to us what is Stellantis, who is Stellantis, and why was it a short?
Stellantis is a European company, and it's a big roll-up.
A roll-up?
A roll-up, yeah.
Of what?
They bought American cars. They bought
Dodge
Ram, and they also bought a couple of companies in Europe, and they are multiple options to people all over the world.
What do you mean multiple options to people all over the world?
You have American cars, you have European cars, you have fast cars, you have expensive cars, you have,
So this is a roll-up of different brands of cars.
Yeah.
Okay. That's not necessarily a bad thing.
It's not.
So what was your thesis? Why was this company in trouble or going to be in trouble?
It goes back to 2020. And the reason I'm saying 2020 is because COVID started and everything was shut down and something else happened. So the government started giving stimulus checks to all consumers, everyone. And that started a whole batch of problems, and I will explain why. So when the stimulus checks went to consumers, some of them started to pay down the debt.
Their own debt.
Right. And some of them started to buy cars.
Bought a car.
What car did you buy?
We bought a Nissan Rogue. And I had an experience I never had before in my life, which was, I'll just make up a number. Let's say the car listed at $40,000.
Yeah.
I think we had to pay like $2,500 over sticker to buy the car because there was such demand for cars at the time.
There you go.
That but we bought it anyway because we needed a car.
Yeah.
So, but I had never had an experience where I paid. I've had experience where I paid sticker. I've never had an experience where I paid above sticker. So that tells you what the demand was like back then.
Yes, and that's where the problem started. So when the demand was like that, manufacturers started to manufacture the car, and what we heard from our sources is that the quality wasn't that good
Of the cars.
of the cars.
Because they were producing too many.
Yes.
So not good enough quality control.
Not enough quality control.
Okay.
So everybody started to buy cars, and people who paid down their personal debt, their credit scores started to go up. So you have, after 2021, subprime borrowers became prime borrowers
Because the government gave them a check to pay off their debt. So all of a sudden there are more consumers who can afford to buy cars because they're going to get a better loan.
Yes.
Okay.
And the car companies and dealerships got very greedy.
Say that again?
Very greedy.
Really?
Yes.
I'm shocked.
So they got very greedy, and they started to, like you said, you paid $2,500 above the sticker price.
Right.
So the demand was there, and they started to jack up the price.
So car prices going up. There are more consumers who can buy cars because they're getting better quality loans with lower interest rates. This is like 2021, 2022.
Yes.
Okay.
And the problem started to happen. All the subsidy money stopped.
Right.
And the reality started to kick in. And that's when, the car companies kept on manufacturing cars. And we literally pulled out a list of dealerships in the United States and started calling.
Just calling dealerships. How many dealerships do you think you called? You and your team?
More than 100.
Okay.
100, 200. And email surveys to them, 300 of them. And we wanted to know how much inventory that they have. And we started speaking with wholesalers. We started speaking with dealers. We started speaking with auction houses. And that's when we realized, Steve, this car industry is such an organized mess. They are all in it together. And you add banks like Ally,
Lending to the people to buy cars.
Yes.
So you have an industry problem where there's an oversupply and dealers have too much inventory.
Yes.
Okay, that's fair. But
That
why
is.
pick on Stellantis?
And that's where the problem comes in. The dealerships, Ram, Dodge, dealerships we spoke with, they started complaining to us that we do not want to take any more inventory from Stellantis
Because?
because they cannot sell the inventory that they do have.
Why?
Because nobody wants it, and that's a different issue. So you have a dealership with 1,000 cars, right? So the dealership have to go and get loans from bank. That's called floor plan loans.
So to hold the inventory.
To hold the inventory.
Right.
So they have to sell the car, and then they have to pay off that loan.
Correct.
They can no longer sell the car because consumers don't want to trade in their car because of the negative equity. And negative equity is, say, you go and buy a car for $30,000, right?
Right.
You buy a car, you make some down payment. You say $1,000 you made down payment. You borrowed money for the rest of the amount. $29,000. And 2 years in, you wanted to trade in your car,
Right.
you wanted to get something fancy, or the value of the car that you're paying, $29,000 loan, right?
The one you're going to sell.
That one you're going to trade in.
Yeah.
The value of the car dropped, and all the values of the car started to drop.
And that's probably because they were sold at, like I did, buying it at $2,500 over sticker price, and then things normalized.
Yes.
Okay.
So when you're going to trade in, you have a negative equity. So the car you bought was $30,000, and you have a loan on that car for $29,000. The value of that same car right now is probably
22.
$20,000.
Right. And your loan is bigger than the value of your car.
Yes.
So if you were going to buy a new car, not only you got to put a down payment on the new car, you got to pay off the negative equity that you have in your old car.
Yes.
Okay. So nobody, but why again, that's an industry problem.
Yes.
Why is Stellantis like in the worst condition?
Because of the amount of cars they've been manufacturing.
So they over manufactured more than anybody else,
Yes.
is what you're saying. Okay.
Yes. And they misjudged the demand.
More than anyone.
Yes.
So did you find, for example, that, I'll just make up some numbers, that a dealership that's a Ford dealership would have excess inventory, but the Stellantis dealerships would have much more excess inventory?
True. And also we didn't want to touch Ford or GM
Because
they are American companies and they have that status attached to it. And we don't want to touch anything that might eventually be bailed out.
I see. Okay.
So it's like I would never short JP Morgan Chase or Bank of America, no matter how crappy they get.
Well, I would, but that's a different story.
You would. Definitely you would.
Okay, so that was your thesis. Anything else to the thesis of Stellantis?
Dealers were unable to pay the floor plan. Ally lending money to the dealerships. We heard recently that Ally is going to the mom and pop dealerships and asking them to hand over the keys because
Of the dealerships. That's recent.
Recent.
So you think Stellantis is still in trouble?
Yes.
And it has a new CEO, doesn't it?
Yeah, but it doesn't matter.
Doesn't matter.
They have no clue what to do.
You think the new CEO has no clue what to do?
You over-manufactured and you underestimated the demand for your products. The quality of the car sucks. So and the customers are absolutely broke. You have the student loan resumption and garnishments about to begin. So now you have a whole new mess of BNPL. I mean, Steve, I didn't mean to go all over the place, but that's how the situation is. You have consumers in the middle of everything, whether you're going to pay the mortgage, whether you're going to pay the car loan, whether you're going to pay your credit cards, or whether you're going to pay the BNPL.
Buy now, pay later.
Yes, and whether you're going to, pay your student loan.
So you think Stellantis goes lower?
Eventually, it will be lower single digits, yes.
Okay. All right. Let's move on to a new short. That's a good short.
Thank you.
So let's talk about, you have two solar shorts.
Yes.
I think this is more complicated. So you have SolarEdge
Yes.
and you have Enphase.
Yes.
I actually know a lot about solar. God help me. So just to give people statistics, you initiated coverage of SolarEdge in March of 2023 at $280.
$329.
All right, $329. Before I get to that for a second, so solar stocks went crazy
Yes.
during COVID because everybody wanted to put, we'll talk about this. Everybody put solar panels on their roof that could because rates were zero.
Yes.
And it cost $30,000 to put a system on your house.
Yes.
And with rate zero, you could probably get loans at 3%.
Perfect.
Okay.
Yeah.
So everybody went nuts. Okay. So SolarEdge you initiated at March 2023 at $329. And the last time I looked, I think a day or two ago, was 16.
Yes.
Oh, and then Enphase, which used to be the darling of the
Wall
what you'd
Street.
call the solar consumer side. There's a consumer side where you put solar panels on your roof, and then there's
Yeah.
the commercial side, which we'll talk about for solar, that creates these huge panels for utilities. So Enphase, you initiated coverage in February 2023, I think at $260.
Yes.
And today, last time I looked, it was $35.
Yes.
So talk about what each company does.
Yeah.
And why did you think they were good shorts back in February, March 2023?
Well, SolarEdge.
Tell us what they do.
SolarEdge manufactures string inverters and panels
And solar panels.
and solar panels.
So inverters, so the panel goes on your roof, and that captures the sun.
Yes.
And the inverter converts the power that the panel absorbs into electricity, I believe, into your home.
Yeah, so the DC direct current, and it has to be transferred to alternating current.
Right. And that's the inverter.
Inverter's job.
Okay, so there's a panel. And for simplicity, let's imagine the inverter is below it, and that's connected to your house, and it takes the DC current that's created from the sun,
To the
converts it
AC.
to AC,
Yeah.
and that goes into your house, and voila, you have electricity.
Yes.
In your
and
house.
SolarEdge also has power optimizer. Power optimizer goes in a corner near the solar panel, and all the string inverters are connected to that.
And what does that do?
It converts the DC to AC.
So you have so solar basically gives a system for your roof.
Yes.
to put it simplistically.
Very
And it costs, like I said, about $30,000
$30,000
to put the whole thing on your roof.
Yes, but the subsidies are 30%.
So they're government subsidies. So instead of paying $30,000, you pay 70% of $30,000.
Yes.
Okay.
So the government subsidies will cover 30%, and the 70% the consumers have to go get a loan. And I think the tenure for the loan is anywhere between 8 to 10 years for the payment.
Okay.
So before we started, and Enphase has the inverter business, and what they do.
But they don't have a panel business. I don't think they really do.
No.
But for simplicity's sake, they more or less do the same thing.
Same thing.
The same thing. They put systems on the consumer's roof.
Yeah.
And Enphase supposedly was better than SolarEdge. Supposedly. We'll come to that. But that was the reputation.
Yes.
Okay. So what attracted you to these companies as a short?
Well, as you know, Robert, so he flagged solar.
This is your partner.
Yes. So he flagged it. And solar company back then in around 2020, as you know, ESG was everywhere. And, everything is green, which I disagree. EV car is not green. So once I started SolarEdge, I started looking for the competition. I started looking at Enphase as well. So I started gathering information about every single solar installers in the United States and distributors. And I spent a month or two calling them and speaking.
How many people do you think you spoke to in 2 months?
More than 100, 150.
So you were talking to the people who were either selling or actually installing these systems. Installing.
Yes.
So these are the people who are closest to the consumer.
Very close.
Okay.
And
what did you learn?
That they don't like SolarEdge that much. Some installers do, but most don't.
And they don't like them. Why?
Because of the high failure rate. So SolarEdge and Enphase advertises that their failure rate is less than 1%.
Okay.
But the installers and distributors were saying that their failure rate is roughly around 40%.
Oh, my God. Let's just review that for a second. So, no, the companies are saying you put our system on the roof and the possibility of failure is only 1%, and the distributors are telling you that it's almost half.
Yeah.
Okay. That's bad.
That's very bad.
Yeah.
And especially,
is that just for SolarEdge or SolarEdge and Enphase? Both.
Give or take 5%.
Okay.
But that is a huge problem because you have solar panels on your roof and you have the inverters. So Enphase have microinverters, which goes on under every single solar panel. So if one inverter fails, then you have the other ones still working.
Right.
And the power is still getting generated.
Okay. So in other words, you might have, let's say, 10 solar panels on your roof with 10 inverters underneath the solar panels, and one solar panel doesn't work because the inverter is not working, but the other 9 are working.
Yes.
Okay.
However, with SolarEdge, we learned that we have 2 problems. One, the power optimizer just goes out. It doesn't work. There are cases where power optimizer doesn't work and the inverters doesn't work.
Both.
Yes. In some cases, power optimizers might work and the inverters does not work. And what happens is the inverters is string inverters. It gets connected to everything. So if one goes out, everything goes out.
So that's SolarEdge.
Yes.
So SolarEdge had a problem that all the inverters were sort of connected.
Yes.
Whereas Enphase was better in that sense. They were not connected in that sense.
Yes.
Okay.
So you're generating electricity and it's there on the panels, but it cannot be converted to, and you can't use it for your house. And that's a problem. And why none of the installers wants to touch it is because I interviewed a lot of installers and cross-verified their answers because, somebody might be just pissed at SolarEdge. So I make sure their answers were consistent. And the installers mentioned to us that the overhead for their truck and hiring 5 people is around $80,000 to $100,000 per week. Mm-hmm. So for them to make money, if they go and install a new system, they make money. If they go and repair and problem with an inverter, they do not make any money. So the installers, instead of recommending SolarEdge or Enphase, they started recommending some nameless products that works really well to the customers.
The names I've probably never heard of.
No. And
Not public companies.
not public companies. And what we also heard, we heard a rumor and we followed the rumor, and some of the distributors were no longer paying SolarEdge because they have so much problems with the failure rate. They don't want to sell it. And
So when did these stocks, because there's always a lot of politics in these stocks,
Yes.
so which we'll talk about for a second. But during the Biden years, people liked these stocks as a way to play the IRA, the Inflation Reduction Act. So when did these two stocks start to fall apart, and why?
that's a great question, because we started digging in and digging in and digging in. And I think our timing was aligned with how the demand started to fall. The timing we got in right.
So here you're saying your timing was impeccable.
Close enough. And I still remember a time when one of our clients called me because it was SolarEdge earnings. And in 2024, earnings season, as you know, it's always 50-50. So SolarEdge reported.
When was this?
This was in first quarter 2024 or something. I can't remember.
Okay, so you're basically, your shorts is about a year old at this point.
Yes. I can't remember the earnings, whether they missed it or beat the earnings. I'm sure they beat the earnings slightly. The management talked it up, and the stock rallied 100 points, Steve.
100 points.
Yes.
Oh my God.
I did not sleep. And
I've never had an experience like that.
And that's when you need to have a solid groundwork of primary research to say, add to the short and stay short, because it will roll over. And for me to call I make sure I call each and every one of my clients, whether the stock goes well or not, because, I personally feel I owe it to them because their money is at stake.
Right.
And I called them and said, listen, our conviction is very high. These are the reasons the stock rallied. It will roll over tomorrow. It rolled over 150 points down in a couple of days.
So it went up 100 points, call it overnight.
Yes.
And then it came back down and was lower later than
Yes.
when you started.
Yes.
That's guts.
It's painful. I did not sleep.
So those two stocks worked,
Yes.
although I'm sure it's been quite a roller coaster. And let me just add, there was something else that happened, which was California, to make a very long, complicated story short, changed regulations that made it less economic for someone to put solar panels on their roof.
Yes. To summarize that very, very quickly, when you have an extra energy, you can sell
This
it
is in
back to the
California.
grid.
You can sell it back to the utility.
Utilities, yes, at more than a couple of dollars, I believe. And there's NEM 3.0 made sure that you can sell it at 0.05 cents per kilowatt.
That was the old regulations.
That's a new
That's the new one.
regulations. Yeah.
So they changed the amount of money you would get
Yeah.
to pay, and that made it less. I think the way someone who described it to me was, under the old regulations, given the amount of money you would make to sell electricity back to the utility, they call it the payback period. In other
Yes.
words, you put the solar panel on your roof for $30,000. How many years does it take to make money so that basically you're even? And I think it was like 7 years.
7 to 10,
Right. And then they changed the rules, and then it was like 15 to 20.
20 years.
Right. So that made it less economically
Attractive,
conducive
yeah.
for people to put solar panels
Yes.
on the roof. That hurt the group too.
Very much.
Okay. So let's go to First Solar, so just to repeat, in solar world, there's the consumer side and there's the commercial side. And the consumer side is SolarEdge and Enphase that put panels on your roof and systems on your roof so that you could get electricity. And First Solar is the largest manufacturer of solar panels to big projects that utilities create.
Yes.
And President Biden, who created the IRA, created incredible tax incentives for people to do this.
Yes.
So leave aside for a second that obviously President Trump has obliterated all this stuff, but the stocks went down before that.
Yes.
So what attracted you to First Solar as a short, other than politics? Because politics we'll talk about, but is there something that attracted you to First Solar as a short, other than politics, or was it purely that you thought that President Trump's going to change this stuff?
A little of both. The product quality had issues. They have, I don't know whether Series 6 or 7, and that has a manufacturing defect that they were sued for. And this started in 2023. And because of that, their warranty expenses started to go through the roof. And I don't know if the lawsuit's still ongoing. And that is one of the reasons that we recommend it. But to be completely transparent, main reason we jumped on it recently, not along with SolarEdge and Enphase, it goes back to the politics. And the Trump administration did not prefer the subsidies as a means to support these companies. Mm-hmm. And that made me to take another look at First Solar. And nearly 30% or roughly 30% or more of their revenue comes from subsidies.
Yes. And probably a higher percentage of their profits.
Yes. First Solar sells its tax credits to other companies, and they make money out of it.
Just from selling the tax credits?
Yes.
Okay.
So there are a couple of companies that buy them in bulk.
Because? Why would they do that?
To offset their tax liability.
I see. Okay. But 30% of the revenue comes from the government in one form or another.
Yes.
So your thesis basically was more likely than not that President Trump was going to get rid of this stuff. And there goes the earnings story of the company.
Yes. But if you take that out, if you take the subsidies out, and if you also consider the fact that Trump is going on and off with the tariffs, and China has been dumping a lot of cheap solar panels en masse into the United States. So, and that is hugely affecting First Solar. First Solar's management reached out to Trump during the tariffs, and when he removed the tariffs and he put it back on. So First Solar management is like, please, you have to implement the tariffs. So this will benefit us. But they couldn't control what the current administration going back and forth.
So where is the current administration on tariffs with respect to First Solar panels?
Honestly, I lost track.
Back and forth.
Back and forth. It's been
But the big thing is that their subsidies are going to go away by 2028. They're gone.
Yes.
Okay. I want to talk about lessons learned, because the way I sort of rank shorts generally, but also through your research, is if I have a short that's a pure, I call it a microeconomic short. Purely related to the company itself, its fundamentals, nothing else is involved. That would be my best short.
Yeah.
Then if I have a good short that's microeconomic but has some macro political stuff, that would be second.
Yes.
And now we're going to turn to what doesn't work. So you recommended shorting Reddit in March 2024. What was your thesis?
They haven't made any money. And when we recommended it, they haven't made any money in a long time.
Are they making money now?
I stopped following it. It's so painful to look at it.
Okay, so they weren't making any money and they hadn't made any money.
Yeah, and they don't have any niche in what they were doing. They haven't made any earnings in a long time, and they choose to become public right when AI mania is going full speed.
Right.
So I think we got caught in the crosswire, so to speak. We never touch a stock that is cult. And
so you won't touch a cult stock?
No.
This is a cult.
This is a cult.
So you went against your own lessons.
And I made a mistake.
Right. The first lesson is don't short a cult.
No.
And the reason why you don't short a cult is people care about, the cultists care about things that you don't think might be important.
Yeah.
But they care about it, and they'll buy the stock on that. And you say, why is the stock going up? Who cares? But they care. The second one is this is one that I've said publicly many times, never short a stock purely because of valuation.
Nope.
Because And there's a little bit of that in this one.
Yeah.
You know,
Well, we learned the lesson the hard way. And a few fund managers reached out to us, as I shared with you earlier, that they want us to help them with Carvana as a short. And they asked me, oh, could you do this for me? I said, I am not going to touch Carvana. And they asked, because it's a cult. We recommended Carvana as a short first quarter 2022 when the stock was around $83, give or take. And our thesis at that time was Carvana was not providing title deed to the consumers who paid cash to buy cars. And there was multiple lawsuits, and we reviewed every one of them and said there is no way this company is going to survive. The stock went from 83 to all the way to $4 or $5 in December 2022. And at that point, I just wrote an email, said, cover the stock, don't look back.
Where is it now?
God, 300 something. I'm not sure.
It's a cult.
It's a cult stock. And Hindenburg came out. I spoke with the CEO, and people argue with me on Twitter DMs saying that it's a cult, and why do you now it's a fraud. And my thoughts to them was, it could be a fraud. It can very well be a fraud, but can you be solvent as long as they continue this fraud in a successful way? And for the answer for that is short sellers cannot stay solvent. You know, Chase, it might be a zero someday, but...
Let's move on to another short. So you, I don't know if you're still recommending as a short, DraftKings.
Oh, no.
You recommended the stock as a short May 2024 at 40.
Yeah.
And the stock is flat right now. So, but tell us what your thesis was and why you've withdrawn from it.
It's
I can see in your face, you know, you take these things very personally. I did too. It's a hard business.
It's depressing, to be honest.
It's not. I would agree with you. It's not depressing. It's humbling.
It's very humbling.
It's humbling to be short a stock that goes up in your face after you've done a tremendous amount of work on it, and you're very proud of that work, and the stock goes like that, and you're like, that it's a very humbling experience.
It's a humbling experience, and I'll tell you what's humbling is that we published the short, and it's a SPAC. I think that's one of the very few SPACs that are still alive. DraftKings. Yeah. And there are a lot of regulations, but what we didn't factor is, you know, it's a gambling stock, and it just comes it's a cult. It's people care.
Believe in it.
People believe in it.
Right.
And you have the merchandise in, you know, I'm a hockey fan, and they have it all over the National Hockey League during the Stanley Cup and everything. So
people get excited.
Yeah.
Right. Okay.
So, you know, you can't go, what I learned is you cannot go short and emotional stock.
That's what I like about Stellantis. They sell cars. Nobody gets crazy. Nobody gets emotional about that.
No.
Okay. So let's talk about the last stock we'll talk about is it's an old. I call this one of your oldies but goodies.
Thank you.
The stock is open. You'll explain what that is in a second. This is old. You recommended shorting the stock February 25th, 2021. The stock open is $30, and you closed it on December 21st, 2022. So basically 2 years.
Yeah.
And the stock went from 30 to $1.26.
Yes.
And I think I looked today, I think the stock is like 75 cents.
It's going to go bankrupt.
You think it's going to go bankrupt? Okay, so first, before we even get to your thesis, what does Open do?
Open Door is...
Open Door Technologies.
So this is a kid who graduated from college and realized that, hey, you know, we can use an app to buy and sell homes. And it tried to circumvent the it's like a Carvana. You know, you pay the price
to buy a home.
To buy a home. Like
Right.
you want to sell a home, you know, Open Door pays you cash, and it takes the home and it resells to somebody else.
So what's the problem?
They were losing thousands of dollars on every single transaction.
Why?
Because they were buying a house. So people were selling the house without fixing anything.
Okay, people like to fix the house before people walk into the home.
Yeah. So you have a house, you sell them, and people know that nobody's going to come and look into it. So they just sold the house to Open Door Technologies, and they got the cash, walked away. And Open Door Technologies got a property, and they go in, and technically they have to fix everything
Before they sell it.
before they sell it.
Right.
And they don't. They just, as one source mentioned to us, they put a lipstick on a peg.
So maybe they would just paint it,
They paint it, put a new carpet.
and that's it.
That's it.
Anything else they would not do.
Nope.
Okay, so why were they losing thousands of dollars on each house that they sold if they did so little?
They were selling the house, and people who were buying it is not paying the actual price that they want. They want it at a discount.
Right.
So they go in, they look at the house, and they say, okay, this is not working, this is not working. And the Open Door Technologies actually have to put up a lot of money up front to fix the house.
Well, wait a second. You said that they didn't put much money up to fix the house. Then
Initially, they
initially,
started.
oh, so then they had a problem. So they had to put more money in to fix the house.
Yes. So then at some point, they stopped doing it, and they said they just put the carpet and, sold it. They didn't do any fixing whatsoever. And the buyer bought the house, and they found problems with zoning. They found problems with leakage, problems with septic, and say they bought the house for argument's sake, $100,000. They have to end up putting extra $100,000 to probably fix it.
Thousands of dollars in.
Yeah.
Okay. And so then they would sue Open Door?
Yes, but Open Door ended up always settling out of court, of course.
Okay. So they never made any money, Open Door.
The CEO was so driven, and he was like this kid just graduated. He said, I wanted to revolutionize the housing market. I want buying and selling the house
To be seamless.
very seamless and very easy.
So let's finish up.
Yeah.
What would you say after the years of doing things, if you had to do it all over again, like have you narrowed down what you look at or expanded what you look at in terms of shorting?
I have a list of do's and don'ts. List of don'ts is never short a stock that's 52-week high.
Really?
Yeah.
Okay.
Wait for it. In that case, I usually wait for one missed earnings, and I would rather leave
Money on the table.
A little bit, rather than have it break out and get screwed. Second one is never short a roll up until it reaches its anniversary, because if a company,
What do you mean its anniversary?
So when a company X buys company Y, and
then Z, and then A, B, and C.
yes, and which means we see the accretion from buying that company will last for at least a year.
So don't short a roll up until
It reaches
they've
the
stopped buying
anniversary.
stuff in its
Yeah.
anniversary.
Yeah.
Okay, that's a good one. I like that.
And do not short cult.
Do not short cults.
No matter how tempting it is. I know some great fund managers who are chasing stocks that they should not be chasing.
Because they're cults.
Carvana and Tesla.
Right.
Elon has been saying robo-taxis every year
Right.
for the past.
And apparently there's problems with this technology in robo-taxi, but nobody cares.
No one cares.
Right.
No one
Amazing.
cares. It's amazing you say that, because I sometimes take a thesis and we discuss it within the team, and I say something else like, hey, the fundamental is bad, this is bad, this is bad. And the partner I work with, Robert, goes, yeah, Lex, but nobody cares.
Right. Okay. That's why Stellantis is a good short.
Stellantis is a great shot. And we are also recommending a couple of dealerships in tandem with Stellantis.
But more or less the same thesis. There's too much
thesis.
inventory.
Yes, too much inventory.
Right.
So 52-week high, roll-ups until it reaches the anniversary, no cull stocks. And the stocks that are good short is the management. It's always the management.
Bad management.
Very bad management. We usually research investigative style researching on each one of the board members and the management themselves, and which companies they worked in the past, why they left, and all those things, because it matters.
It does matter.
It does matter. And management, the fundamentals. We look for receivables. With SolarEdge, accounts receivable was
Going up too much.
very much.
You also look for, obviously, for increase in warranties.
Yes,
That's
increase
bad.
in warranties.
Right.
And liabilities. The balance sheet story always comes in place. And there are hundreds of solar companies that have gone bankrupt in the past 5 to 10 years, and most of them have problem. There was one solar company that filed Chapter 11 today, Mayor something,
Not public.
MEYER. I'm not sure. Not public, I believe. But their liability was $1 billion. Wow. And the asset was anywhere between 100 to 500 million.
Wow.
So most
Really
of,
upside down.
yes, because the solar companies have a lot of upfront cost. So they build this infrastructure without actually gauging in the demand that they will be receiving. And that pretty much swallows them.
Well, Sonova. Did Sonova file for bankruptcy? I think
Which one?
Sonova.
Yes, they did.
Okay. They filed
They
for
did.
bankruptcy. Okay. Thank you.
Steve.
Very educational. Hope everybody will enjoy it.
Thank
Thank you.
you. Thank you so much for having me, Steve.
My pleasure. It was wonderful. Thank you.
Thank you.
This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.